how to defend a losing futures trade. This is a tough one because theoretically futures trades, Jermal, are 50-50. And what we're trying to do when we put on any futures trade, when we're buying or selling any market, today we're looking at interest rates, is we're hoping that our research or our gut or the data or what have you, whatever's making you push that buy or sell button, is putting some edge in your favor so that, it's theoretically 50-50, but my data, my research is giving me 55%, 60% chance of this trade going my way. That being said, a good chunk of your futures trades are going to be losing ones. And I want to go through 3 different options for defending those losers, because I've got a loser that we're about to dive into with interest rates. But I mean, we all deal with losers, right, Jermal? And having, defensive mechanics is the best thing to do. The worst thing to do is the black tape method. Just, I'm going to put tape over the P&L for that, right, and forget about it. And just, my thing used to be at the board of trade, I'm going to go to the bathroom. And hopefully by the time I get back, it's no longer red, it's green now. And it never really worked. I mean, you've probably defended a bunch of losing options and futures trades, right?
Oh, for sure. Yeah, I wouldn't go to the bathroom anymore. That's not going to help your confidence at all. But in the future,
oh, there it is. Everybody get that? That's I'm
sorry, that was a layup. Come on, you handed me that one.
Pretty good.
It's always nice to at least know where the exit is, right? Like in general, you got to at least kind of have an idea of, hey, where I might exit this trade, or at some point I might have to take some evasive actions for sure.
Absolutely right. And so here's a trade that, like I say, interest rates at their highs since 2008. I'm going to go in and I'm going to get short, banking on this historical data telling me that I've got some edge, like I can lean against the fact that we're at a price extreme here. And when we get up here, the market tends to mean revert. It didn't go my way, or it hasn't gone my way yet. So how am I dealing with a short S10Y position, a short 10-year yield position that got to these highs? I sold it and now is extending as we speak through it. Well, I've got 3 different options for you, Jermal, ranging from least aggressive to most aggressive. And I'm sure you've probably exercised each of these. But why don't you just walk us through? I've got a short S10Y position. What would it mean to sell a put against it, or spread off the risk against it, or merely manage the loss, the most aggressive? And, feel free to, you could do this with S&Ps, if I was, long or short S&Ps, whatever kind of example. Why don't you walk us through these 3 quick defensive tactics?
Well, in general, if we have a situation where we have this bad short, a lot of times, let's just take, for example, if something's really rising up high, that's usually a situation where we can get some skew in those puts. It does create this potential situation where you could sell some downside, give yourself a little bit of long delta and sort of offset some of your loss, especially if it continues to go. Now, obviously, this is just sort of a bandaid type of situation, because that gives you some long delta, but obviously not equivalent to the amount of short delta that you already have. But nevertheless, it's a risk reducing scenario. Same thing with spreading off. Like in this situation, I think this is good to talk about the rates, because as you can see, we pointed out, they're all moving up because of the rate hike expectations. So if you're able to buy, a 10-year versus a 2s that you're selling, another way to spread off some of your risk. Naturally, the idea and the feeling a lot of times is people like, well, I know this thing is going to move down at some point, and me buying that is going to, reduce the amount of money I make. Yeah, I mean, it is. But that's kind of what a hedge is, right? Like in general, the hedge is going to reduce the amount of money that you make, but yet you can sleep a little bit better at night when, like we've shown the last couple of days, it's literally been out of our control, these moves we've seen in rates. And then by manage the loss, I'm assuming there you mean sort of closing out at some point, whether you close out completely, or if you have on 2 and you decide to close out 1, this is just another different way of managing those losses. How'd I do it? Did I get that right?
You absolutely nailed it. And so I'm just going to quickly tear through a little visualization and elaboration of what my friend had to say. Yeah, you're short a market here in the 10-year. You go in, you could sell a put either in the same market, or what's a really nice companion piece is TBT. And just to Jermal's points, the market's at an extreme. The options are juiced. You're going to get a nice price for selling that put against your short future. Now, this is a dynamic hedge. If the market just continues to rally, my put being dynamic is going to lose deltas and my hedge is going to kind of go away. So it's the least aggressive, but it's a nice band-aid for the moment.
Oh, but you know what? We should at least mention the type of delta of put we would sell.
Yeah. And so what I mean here by 5 to 50%, to Jermal's point, is like you can sell a 5 delta put. That's the really least aggressive thing, to a 50 delta and at the money, which is kind of the most aggressive put I would sell. I usually just go to like 20 or 30 deltas, depending on how I'm feeling. If I'm out a good chunk of change, I'll go to the at the money and sell that put right there. Like if I've got, 2 or 3 short contracts and I'm like, man, I need a fat hedge, I'll sell that 50 delta in there. Now, spreading off is going to be your next most aggressive idea. And what's really nice is with this huge rally, markets moving to outliers, the spreads are also at extremes in here. So I'm short the 10-year. I can buy that 30-year against it. I've got now theoretically a 100% static hedge that's not going to lose its value. And I still pretty much want that 10-year to move lower. I want rates to kind of normalize. And so I still essentially want the same thing, but now I've hedged 100% theoretically of that risk, and it moves up and down with the market. If the market explodes higher, I don't lose that hedge, Jermal. Now, the last, managing losses, a tough pill to swallow, but if you are, you sold the 30s in this market and it's now at 33 or 34, you're out 300 or 400 bucks per contract. And you're like, man, I'm at my loss limit and I don't feel good about this position. I feel uncomfortable. There's nothing wrong with taking that future off and taking a deep breath, taking a step back and looking to either enter back into that position or take the capital that you freed up from that trade and move elsewhere. How do you think I did there with a quick rundown of defending a losing futures trade?
Nice work, man. You nailed it.
Thank you very much, my friend. Always a joy to have you, Jermal. Thanks so much for coming on. Make sure you're checking out Engineering the Trade, and you're also following him on social media and everything else. You can also find him in the outfield of Comiskey Park. That's where he likes to hang out on the weekends. And you're the best, my friend. No, truly, thank you for coming on. Everybody, stay tuned for Splash in the Futures coming up next. Get ready for FOMC tomorrow. I'm sure Pete and whoever he has on today will be talking that up. So stay tuned and have a great night. Peace.